securing our understanding of the Secure Act, retirement trips to Europe, and translating your nest egg into lifetime income. All this and more on today's episode of The Wave Strength.
Welcome to The Wave Strength. Innovative pension solutions for a secure retirement. Presented by Pacific Life.
All right, everybody, thank you so much for joining us today on our inaugural episode of The Wave Strength, Pacific Life's newest podcast. In this podcast, we discuss innovative pension solutions for secure retirement. And we're very excited today for this first episode. We're going to be discussing a very important topic, basically an overview of the Secure Act. For those of you not familiar with the Secure Act, it's a piece of legislation that was passed in 2019. Many of the provisions went into effect in January of 2020. With me today to discuss the Secure Act is Amit Kamil. Amit, thank you so much for being with us today, especially today on our inaugural episode of the podcast.
Yeah, Jim, thanks so much for having me. I'm looking forward to it and feel honored that I was part of your inaugural show.
Thanks, Amit. I appreciate that. And we're really excited to dive deep into the Secure Act and these provisions. But before we begin, can you talk to our listeners a little bit about your role at Pacific Life?
Sure thing. So my role here at Pacific Life, I guess we'll say the official title is Director of Product Support. What that means is I am focused on bringing to life Pacific Life's defined contribution lifetime income strategy. I've dedicated my career to financial services, 15 years now. And the passing of the Secure Act has given us the tools to really, push our initiatives forward in delivering retirement readiness to Americans everywhere.
Thank you. So let's jump right into it. Let's start by kind of unpacking the Secure Act and maybe you can discuss why the Secure Act is so important to the retirement industry.
Sure thing, Jim. It boils down to one very simple point. We as an industry need to be in a position to help our participants retire comfortably and make sure that their assets could sustain them for their lifetime. With that being said, there has always been a disconnect between the importance of that goal and how to implement that. What the Secure Act does is it takes away some of the pain points that come along with being able to implement those types of solutions inside of your retirement plan.
Okay, so with that said, let's go into maybe a deeper dive as to what is inside that piece of legislation. Maybe you can walk us through what the Secure Act does on a base level.
Absolutely, Jim. So the Secure Act as a whole has 30 provisions. It's over 100 pages long, and every single one of those provisions is important to the retirement industry. With respect to what we're talking about today, and as to what my focus is here at Pacific Life, which is defined contribution lifetime income, there's really three elements of it that I like to put a lot of focus on. Those elements are the portability provision within the Secure Act, the expansion of the safe harbor, as well as a lifetime income disclosure provision. And for the purposes of today's conversation, given that recent guidance was just put out by the Department of Labor back on August 18th, I think maybe we should focus a little bit on the lifetime income disclosure provision.
That'd be great, Amit. I think our listeners would really like to learn more about that.
Absolutely, Jim. Happy to. So lifetime income disclosure, in my opinion, is going to play a real critical role in retirement readiness and retirement awareness. Right now, when somebody logs in to their 401k or their defined contribution account with their employer, they could see a few things. They could see what their account balance is. They could see what their investments are, and they can make changes, within their investment portfolio and their selections, right there online. What some administrators seem to lack is being able to show those participants what that large balance or what that lump sum balance translates to in the form of income. So what the lifetime income disclosure provision is saying now is it is requiring that administrators provide a lifetime income calculation to all of its participants, at least on an annual basis.
So instead of going in and just seeing that one lump sum, so at 65 or at 72, you would have this amount of money. The idea is, hey, what would that translate to in terms of maybe is it an annual check or a monthly check? How does that break down?
Yeah, so great question, Jim. So as I said, right now I log on and I can see a lump sum amount. So let's just say, for example purposes, I'm logging on and I see that I have $250,000. As I see that number, I say to myself, that's quite a large number, and I may have a false sense of security in seeing that large amount, right? What this disclosure does is it says, hey, we're going to take a look at that $250,000, and we're going to tell you, based on that amount, what your income would be on an annual basis for the rest of your life, starting at age 67 years old. So now what I'm seeing is not just a lump sum, but what I'm seeing is essentially a paycheck that's going to last me for my entire life. And it's at that point where I could sit and say to myself, or make the assessment of whether I'm on track or I need to do more work.
Yeah, I could see that really being an effective way for folks to visualize really their life in retirement. Like that $250,000 number you mentioned before. If you're looking at that when you're 40, 45, you're going, okay, that's great. Okay, I'm got that nest egg there, and now I got to take the kids to school, or now I got to focus on this. And you don't think, okay, wait a minute, let's pump the brakes here. Let's see how that $250,000 is going to last at retirement. And so perhaps this paycheck mentality provides the opportunity for that participant to go, wait a minute, if I want to do that occasional Europe trip, that paycheck is not going to cover it. Then that 250 needs to be much higher.
Absolutely, Jim. You nailed it on the head. The point, in my opinion, of this provision is for participants to do exactly what you just did, to understand what their minimum requirement is in the form of income to keep the roof over their head, to keep the lights on, and to keep the food on the table, right? And then anything that happens after that, those vacations, the new cars, whatever else that a retiree wants to spend money on or plans to spend money on, it's at that point where somebody could say, does this amount that I am shown to be getting if I were 67 today, is it going to be sufficient to check all those boxes, or do I need to do more?
Yeah.
There's a few things to consider as we talk through the guidance from the DOL, and we can get into that a little bit more in detail in a little bit here. But I think this is a great starting point to raise awareness around those issues.
Yeah, great point. I mean, even just keeping the lights on and food on the table obviously is most important. Yeah. The first thing I went to is that trip to Paris, but I guess I should be a little more practical with my retirement goals.
But you know what, Jim? This is your line of thinking is in line with how many people think, right? Yes. They tend to look past those bare necessities to the leisure part of their retirement.
Yes.
Rightfully so.
Yeah.
You've worked your whole life. You want to be able to take advantage of the free time and do the things that you didn't get to do as often when you were working. And that's really why, this is an important thing, because it allows people to build that journey and make sure that they stay on track to achieve those goals.
Yeah, even more of a reason why that kind of paycheck mentality can really help visualize what the reality will be in retirement for those participants. Can we talk about the portability of the lifetime income options?
Yeah, absolutely. So from a portability standpoint, this has always been a pain point amongst plan sponsors, and administrators alike. As it stands today, or as it stood prior to December of 2019, if you incorporated a lifetime income solution inside of your plan, and for whatever reason the sponsor decided to discontinue the offering of that product, or the administrator decided to not administer that product anymore, it left a lot of people who were invested in those products with no option other than to essentially liquidate and move into another investment. Now, many of those people have already accumulated guarantees as they were on the path to retirement. So you can imagine losing that guarantee or that benefit, which is also a benefit that they've paid for, is a hard pill to swallow. What the Secure Act has done in the form of the portability provision is it has said to plan sponsors that, hey, if you offer an in-plan income solution, And by way of an administrator, the solution goes away, or if you need to discontinue the solution for whatever reason, your participants have the option, regardless of their age, to take that portion of their portfolio and roll it into an IRA with the income provider. What that does is it preserves, one, the value of the investment, of course, but more importantly, it preserves the benefit that was promised to that participant. And that's really the crux of that provision.
That's huge. Yeah, that's huge. That's a big deal.
Very huge, yeah.
Yeah, and that's important for people to understand too. So, I mean, otherwise, they might feel locked in.
Absolutely. And the fear has always been, if I offer this to my participants, they invest in it, they pay for the benefit, and then I have to take it away. What kind of message am I sending to my participants? And that was always the main concern around portability, which has effectively, went away with the inclusion of this provision.
So, Matt, let's talk about the expansion of the safe harbor.
Absolutely. So it's important to note that this is an expansion, right? And I use the term expansion because many sponsors or administrators see this and they say, oh, we finally have a safe harbor provision. We've had the safe harbor provision in place prior to Secure Act. It just was lacking the transparency needed to make sponsors comfortable with including a lifetime income option. What the safe harbor's intent is to relieve the sponsor of fiduciary liability in the event that they select an insurer and that insurer goes insolvent down the road, right? So this provision, what this provision has done, as I mentioned, has provided an expansion on that safe harbor. And what that means is they've made it more transparent. So now they have actually set forth transparent, straightforward guidelines that a sponsor can use to assess the viability of the income provider. What that means is if I'm a plan sponsor who wants to incorporate an in-plan income option with insurer ABC, let's say, I can request a letter of representation from that insurer that provides me all the information I need that to make me comfortable that they fit the parameters of my guidelines to include them as a provider. Now, as long as I've done my due diligence, and I do that at least on an annual basis, if at some point that insurer goes insolvent, I know that I have done my due diligence and I have conducted the assessments that I need to conduct, hence giving me some relief from a liability standpoint or fiduciary standpoint.
From the perspective of the plan sponsor, I could see that protection is a big deal. It's in effect a safe harbor.
Absolutely. Yeah. It's very important for sponsors to be able to rely on the information that the product providers give them to make their assessments and do their analysis as they're deciding on which provider to go with for their income solutions.
So, Ahmet, let's circle back if we can and discuss lifetime income disclosure a little more.
Yeah, certainly, Jim. I think that makes sense, being that the most recent guidance from the DOL was on this provision, the lifetime income disclosure provision. So early on in the call, I gave a little bit of an overview in terms of what the lifetime income disclosure does. We'll touch on that a little bit again, if that's okay, and then maybe dive a little bit into how those calculations are provided and maybe some problematic concerns around them. So
absolutely. Yeah.
So as I said earlier, the lifetime income disclosure requires that administrators provide a lifetime income calculation to their participants at least annually. The disclosure shows their participants what their total account value would equate to in the form of an annuity payment. So taking it a step further too, they're requiring that the administrators show not just a single benefit, which is a benefit that's payable only for the life of the employee, but also a spousal. So what would that look like if you were to get a payout for the rest of your life for yourself, and then when you pass away, to your spouse as well?
Interesting.
Yeah, and what's even more interesting is the DOL is requiring these calculations be provided even if the employee is single. So if they're not married, they still want them to see, hey, if you were married, here's what that payout would look like.
Why would they add that provision for a single individual?
So I think it comes down to just covering all bases. Really, when you talk about annuities and pension benefits, you look at it most primarily from two lenses, a single benefit and a spousal benefit. So I think just giving individuals that context around, hey, here's what it looks like if it were just payable to you versus here's what it looks like if it were payable to you and somebody else, gives them an idea in terms of what the difference is in that payment. And they understand a little bit about the impacts of covering two lives versus one life.
Okay, so Matt, you mentioned some concerns about the guidance. Is there anything you see as problematic from an administrator's perspective?
Yeah, that's a great question, Jim. So with any guidance put forth by the DOL, you're going to get industry experts and those that are intimately involved to analyze the guidance and really it's put up for scrutiny, right? So that's no different here in the guidance that the DOL put forth on the lifetime income disclosure. They've actually opened up what they call their comment period for 60 days, which allows anyone that has a vested interest in this guidance, in this provision across the industry to provide comments on what they see as potentially problematic or improvements that can be made to the provision. So one of those pieces that I could see being problematic amongst, more broadly around the industry is how they're calculating that income. And let me elaborate on that a little bit. So they're using the assumption that the person that is getting the calculation is 67 years old, right? And that's what they want to use for everyone. That's the guidance. Say, hey, assume that the participant is 67 years old. The other element of it is the amount that they have in their retirement account. So that's all well and good for somebody who is, say, 55 or 60, because they've accumulated, for the most part, quite a bit, and they're close to that age 67. So it gives them a relatively accurate shot, a snapshot of where their income may be when they hit that age 67. Now, where it falls short is for that individual who's, let's say, 30, who has just started their retirement savings journey, right? They may not have a sufficient amount saved. So assuming that that person is 67 with the current balance that they have, which is probably not too high, the annuity amount they're going to see is going to be very little. It's not going to be impactful. It's not really going to raise the awareness that it should, right? So what has been talked about, or what I imagine would be some of the comments around that element of this provision is there a way to incorporate projections, right? So if you are 30 and you have a small account balance, can we incorporate a projection element to this that shows that account balance growing and what it would be at age 67?
So, Amit, you mentioned some of the problems that administrators may face, but let's talk about some of the advantages of the provision.
Yeah, sure thing. I think first and foremost, as an administrator who is now going to be required to present their participants with an income value, the first thing that would come to mind for me is, am I protected from a litigation standpoint in doing this? I want to make sure that I'm not going to have somebody who comes to me and says, hey, you told me I'd be getting this much at retirement, but I only got this much and now I'm going to sue you, right? So yeah, that of course is going to provide a little bit of heartburn for administrators as this is getting implemented. As per the DOL guidance and as per this provision, they are including what they call model disclosure. So it's what the DOL calls model disclosure. What that essentially means is, as long as you are using the assumptions that are set forth by the DOL to make these calculations, right? Which are the participant's account balance, of course, assuming that the participant is age 67, showing a single benefit and a spousal benefit, and using the 10-year constant maturity treasury as the driver for the rate that's being represented, which, by the way, that is the treasury that best represents the actual pricing of retail annuities. So as long as they follow those guidelines for those assumptions, and they use the model disclosures that the DOL has set forth, they are actually protected from a liability standpoint, meaning that a participant can't turn around and sue them because the income that they've actually received at retirement was different than what they saw annually from the administrator. So It's important.
That's huge.
Yeah, it's huge. I mean, it's as an administrator, I like hearing that I have liability protection, right? But again, it's important to note that in order to obtain that liability protection, the proper assumptions and disclosures as set forth by the DOL must be followed.
Amit, this has been enlightening, and you've done an excellent job unpacking this for our listeners, talking about these new provisions. Is there anything else you have or would like to wrap up with?
Jim, yeah, I mean, I think we touched on a lot today, and I look forward to diving deeper on some of the other provisions that we touched on, like safe harbor and portability. But, for the purposes of today, I think, the key thing that we want to focus on here is that many of our American workers here have unrealistic expectations of just how much money their retirement asset is going to last them or how much income they're going to derive from it. So the point of this provision is really to set that expectation early and either give folks a peace of mind that they are on track or give them an opportunity to reassess their strategy and to get where they need to go. So Jim, thank you so much. Thank you to your listeners. Thank you for having me a part of this, the inaugural show here. And I look forward to doing more of these.
Excellent, Amit. Yeah, I'm real grateful for you taking the time to discuss this with our listeners. And to our listeners, thank you for joining us today on this episode of The Wave Strength. And I encourage you to visit pacificlife.com if you have any other questions. Amit, thanks again and have an excellent day.
This has been another episode of The Wave Strength, presented by Pacific Life. Don't forget to catch us on YouTube and make sure to subscribe. Although this podcast is presented by Pacific Life, the opinions and views expressed are those of the hosts and participants and do not necessarily reflect Pacific Life's views on any of the topics discussed. Pacific Life is a product provider. It is not a fiduciary and therefore does not give advice or make recommendations regarding insurance or investment products. Pacific Life, its affiliates, its distributors, and respective representatives do not provide any employer-sponsored qualified plan administrative services or impartial advice about investments, and do not act in a fiduciary capacity for any plan. Pacific Life refers to Pacific Life Insurance Company, Newport Beach, California, and its affiliates, including Pacific Life and Annuity Company. Insurance products are issued by Pacific Life Insurance Company in all states except New York, and in all states by Pacific Life and Annuity Company. Product availability and features may vary by state. Each insurance company is solely responsible for the financial obligations accruing under the products it issues. This podcast was recorded on September 3rd, 2020.